Okay, in this recording, we will finish the journal entries all the way through December 1. I think we'll be able to make it through. So let's look at August 15, billed a customer $18,000 for services provided during August. So a couple key things. Services were provided. That's the definition of revenue. And then we're billing the customer. We're not actually receiving cash. So what are we getting? So what we gave up is services were provided. And again, we call that revenue. Goods and services provided, by definition, that's revenue. We did not get cash for it. We're going to receive cash in the future. So we will have accounts with our customers will have accounts with us, and we will receive that money in the future. So we have an account receivable with this customer. So we provided goods and we provided services, that's revenue, and we received an account receivable. So then identifying what each of those are. This is something that has value, a resource, an economic resource. We own it. Account receivable is an asset. And of course, this is revenue. So let's go back and put that into our horizontal model. So accounts receivable, 18,000 is going up. And over here under retained earnings, right, we've got $18,000. That's earnings for service. I think it's, we'll probably have an account called service revenue. All right. And then we would go make the journal entry. Actually, I guess we need to assign debits and credits, don't we? This side goes up with a debit, and this side goes up with credits. So service revenue, as sloppy as that is, that's an N, that's a U. So service revenue is our credit. So we can jump over and we can see here's the journal entry. Debits go first, and then our credit to service revenue for 18,000. Now, I just noticed that we had not been tracking these cash flows. So let's go ahead and do that while we're on it. The first one was a financing activity, right? We finance assets with debt and equity. So cash coming in from equity is a financing activity. Over here, we paid cash for rent. Eventually, we will use this rent and it will become an expense. Cash paid for expenses are operating activities. To put that in black, operating activities, right? Cash received from revenue, cash paid for expenses are operating. This $24,000, a customer prepaid, we owe them services. Eventually, we will provide those services. So this cash in is an operating activity. Again, this one's related to a future expense. This is related to a future revenue, which causes these to get categorized as operating. This $1,500 was also for supply, was a payment on the accounts payable for supplies, which will eventually be used expenses, so that makes it operating. Again, we will eventually this was a cash payment. This one's more complicated. Cash payment on this accounts payable. The accounts payable is because we bought supplies. Eventually, we will use these supplies and they will become an expense. Now, shortcut all of this is if something's financing, it's because, right, of long-term debt or stockholders' equity. Again, long-term debt or stockholders' equity. Investing is with long-term assets. If it's not investing or financing, it's an operating activity. So that's kind of a shortcut, easy way to remember that. Okay, let's go back. September 15. completed a job and received $8,400 cash for services rendered. Okay, the services have been provided and we collected cash for that. So this is more of an easier one. So, relatively speaking, we're collecting cash and we're providing services. So cash is an asset. Services provided is revenue. And then I'm going to put this on my horizontal model. Cash is going up. So cash is going up of $8,400. And then revenue is part of earnings. So $8,400 service revenue. I'm just going to write revenue to shortcut it. Okay, so this side equals that side. Assign debits and credits. This side goes up with the debit. This side goes up with a credit. I'm going to debit cash, credit revenue, and let's take a look at what the solution looks like. So here we go, debit cash, credit revenue, $8,400. October 1, paid an employee salaries of $12,000 cash. Paid the salaries, $12,000 cash. So what we gave up is the easy one because we gave up cash. What are we getting? Well, employees worked for us, right? So they have provided services, past tense, they've already worked. So that is an expense. We have consumed the services of the employees. They worked for us. Business has consumed that cost. Cash is an asset. Cash is going down. We gave it up. The expense for employees worked. So let's go back and put that on our model. So cash is going down, $12,000. And then retained earnings, expenses cause that to go down. Salary expense. And this gets a little complicated because the expense is not going down, but it will cause retained earnings to go down. So when we actually get into the account itself, salary expense will go up, but it's a negative retained earnings account, so to speak. Okay, signing debits and credits. Whatever causes this side to go down is a debit, and then you would write that journal out. Journal entry out. Can get that to come up. Whoops, didn't mean to do that. Okay, so cash, debit, service revenue, credit. Oops, I said that wrong. Salary expense is the debit, cash is the credit. Sorry about that. All right, so let's go to October 15. October 15, received cash from accounts receivable. So let's kind of go back here. On the 15th, we provided services on account. And of that $18,000 of accounts receivable, we're going to collect $15,000 of it. So we are receiving cash. Up. We are receiving cash, and what we gave up is a decrease in our receivable. I think I misspelled that. Sorry. I before E except after C, right? So the E comes first this time. I before E except after C. Okay, cash then is an asset. And again, accounts receivable is an asset, but it's going down. That's what we're giving up, is a reduction in the receivable. Go back to our horizontal model, and cash is going down 15,000. Oops, sorry about that. Cash is going up 15,000. And accounts receivable is going down 15,000. And nothing happens on the other side. So it's an asset exchange. Give up an account receivable in exchange for cash. Assign our debits and credits. This side goes up with the debit and down with the credit. So when you go to your journal, you'll debit cash and credit accounts receivable. All right, so on October 15, we're going to debit cash, credit accounts receivable 15,000. Okay, November 16, billed customers 42,000 for services rendered on account. We've already done one like this, so we'll kind of try to quickly go through it. So again, we are providing services. So we know that is revenue. We are not getting cash. We are billing those customers. So we have an account with our customers, and we will receive that in the future. So right now, that is a receivable, and that's an asset. So we're getting accounts receivable. So that's going to go up 42,000. And the other side, we had revenue of 42,000. And it would be service revenue. Okay, so then assign your debit and credit and put it in your journal. So November 16, debit accounts receivable, credit revenue. Okay, one more to go. Paid a dividend of $15,000 cash to the stockholders. Paid a dividend of $14,000 cash. Again, recall, dividends are distribution of earnings. They cause retained earnings to go down in the long run. So in this case, we're going to give up cash, and we're going to reduce our retained earnings because we are distributing it. It's a distribution of those earnings. Cash is an asset. This distribution of earnings is called a dividend. So cash is going up, right? This is going to go up. Retained earnings will go down via the dividend. So let's put this in the horizontal model. Cash is going down 15,000. And then over here, retained earnings will go down 15,000. And that's for the dividend. And then here in Chapter 3, we assign debits and credits. This side goes down with the credit. This side goes down with the debit. And so then our journal entry would be to debit the dividend and credit cash. Okay, and then let's see, I see again, I neglected these. This is cash coming in from revenue, so that makes it an operating activity. This is cash paid for an expense, again, another operating activity. This is cash collected from accounts receivable, which is from a revenue, making that an operating activity. And then this $15,000 is a dividend. Dividends are cash going out for stockholders' equity. Cash paid for long-term debt